Hi, everyone, and happy Friday. Welcome to the show. I'm Alissa Coram here, and this week we have Charles Harris, longtime O'Neill portfolio manager. Always great to see you, Charles. Happy Friday.
Thank you, Allie. Really nice to be here. Happy
Yeah,
Friday to you as well.
great to have you on the show, and good to see that you're no longer in your garage studio like
I've
we've
moved
seen
into my
you.
office.
Like we've seen you in the past at IB Live, yeah. So in your office, great to have you. So to kick things off, I really want to get your take on current market conditions because we are starting to see some more positive signs and starting to see things turn in the right direction. The market still has a lot to prove, but what's your take on where we're at right now? I know that's a loaded question, but we'll dig into some precedents too. But where are we in this market right now, do you think?
So, notwithstanding today's action, which was, a pullback, and it's, I think, to be expected when you've had, the beginnings of a rally, there's going to be some give and take. But, the composure of the market has improved a lot, in my opinion. We've had a follow through day. We've had a couple of subsequent follow through days. We're now trading above the 21-day and 50-day moving averages. So even though the news is still bad and there's a lot of headline risk, and now we're in earnings season, and you see a number of stocks kind of blowing up
Yeah.
in earnings like Snap, and there's been some pretty harsh responses to earnings misses. There's also been some positive responses. So Tesla reported a good number and it responded well. So, I think the environment is still difficult, but it's moving in the right direction. And you want to, try to let the technicals guide you as opposed to the commentary out there and how you're feeling and the headlines, because the market's looking forward. The market's discounting a lot of kind of bad news that we've had and that we're expecting to have.
Mhm.
And, things are starting to move in the right direction. But we're definitely not out of the woods, in my opinion. And there's really not that much to buy yet, at least not if you're following kind of an O'Neill approach where you're looking for stocks that are near proper pivot points, or, have had built sound bases. I mean, the damage has been so extensive this year that, there's a lot of stocks that are just, that it's going to take a long time for them to recover. So I think looking for some new leadership makes sense. But I would expect that if the market continues to move up, you're going to have bases form. There'll be some new leadership. There'll be some old leadership that starts to come up. And I think employing a combination of looking for new stuff and maybe getting some earlier entries on some kind of proven leaders might
Mhm.
be a decent approach.
All right. And to further explain a lot of your points, we will be taking a look at some historical charts that are really eye opening and kind of explain your take on what we're seeing right now and how investors should be handling current conditions. But before we get to that, as you mentioned, earnings season and next week is a big week, the big blockbuster earnings week with all the or most of the mega cap tech companies reporting, and we have the Fed coming up. So a lot of potential market moving headlines could come out of next week. So how do you think investors should be positioning themselves exposure wise heading into a week like next week? Like you said, not a ton of quality setups out there. Could be a big week in a positive way. We could be up, down, all around, could be negative. There's just this big unknown right now in the market.
Yeah. So because there aren't that many proper setups, and the rally is so nascent, I wouldn't recommend having a lot of exposure at this point. I mean, if this turns out to be a tradable rally, or even the beginnings of a major, a longer term uptrend, there'll be time to get into the market. So there's no need to rush in and get fully exposed or get anywhere near margin. Um, like right now I have exposure in some of my managed accounts um, in the 15 to 20% range, trying out a few things, but nothing big. In my personal accounts, which you guys know about because I talk about it on IBD Live, I still maintain a very big position in Tesla, and I've held as much as I can handle and as much as I can. So that's treating that a little bit differently, but barring that, I think this is an environment to not to game earnings. You cannot game earnings. You'd have no idea how a stock is going to react to earnings. Even if you knew what the earnings were going to be, how the stock responds can surprise you. So I think the safe thing to do is wait for companies to report results. I wouldn't get in ahead of an earnings release, and take some small positions on things that are breaking out or perhaps pulling back to a logical area, and see if you're making some progress. I mean, I don't think this is a market to be exposed more than 20-25% at this early stage. When I look back at the 2008-2009 bear market, which was the last major bear market we had that wasn't really just a little intermediate, 3-month kind of thing,
Right.
where it was extended and stocks were in a longer term downtrend. When we came out of that in March of 09, I was actually looking at my trading sheets, and it took me probably a couple months before I was starting to get more heavily invested. So you really want to just start to test the waters, see if you're making progress. If you're making progress, add to positions, add to your exposure, and wait and see, because it's possible that we haven't seen the worst yet. We might retest, we might go lower. I mean, who knows? No one knows. The rally is way too young, but things are starting to feel better. I mean, 4 weeks ago, if you looked at the top 10 industry groups, the top 9 groups, 1 through 9, were all oil and gas related, and energy coal. So that was the top 9 industry groups. Today, in the top 9, we have solar, which I would consider more of it's energy, but it's more kind of a speculative, growthier type area. It's not oil. You've got 2 groups in retail. You've got biotech. You have you have biotech, and you have one in the medical sector, and you have computer software in the medical industry, up from 113 to number 13. So you can see that growthier groups that O'Neill type followers are more apt to trade are starting to move up in the ranks, which is a good sign. I mean, you're not gonna, if it was just all energy and commodities, utilities, that's not where growth investors get their performance. So we're starting to see the right move, but still the pickings are pretty slim. So you really can't be heavily invested because there's not that much to buy. But like I said, like in 2009, the market bottomed in March.
And we have charted that actually that we can pull up and show
that. We can pull that up, and I can throw up some of the stocks that I was trading back then, and you can see that they did offer some early entries back in the follow through zone, but it took months and months for them to actually complete bases and offer more traditional pivot points. So I think that's what we should kind of be orienting our eyes toward, is these kinds of setups, because again, the damage has been extreme this year. I mean, many stocks, the growth stocks, tech stocks with great earnings are off 50+%. And the speculative growth stocks without earnings are off 75 to 90%. So you don't see that very often. I mean, it's been brutal. I hear a lot of commentators saying, well, we haven't seen capitulation, and they keep waiting for another shoe to drop. But it's been bad. It's been really bad. And in fact, I pay a lot of attention to the secondary psychological indicators, which have really, I've over relied on them this year, and to my detriment. I mean, it's been a terrible year for me because normally these secondary indicators, while they're not great timing mechanisms, they will usually, point you like, you might be near a bottom. But the
Yeah.
truth is, you've had oversold conditions now literally since the end of January. You've had plenty of indicators that we're already at extreme levels, and now we're into July, and we're finally just starting to turn. So I really am surprised at how bad the market has been, and how these contra indicators have really continued. They've been so persistent and negative, and haven't really been that helpful in calling a bottom. But I mean, I can go through, just to give you an indication of how rough it's been and how these indicators have gotten so extreme. Some of the ones I follow are the AAII survey, right? So that's a survey of individual investors, so more of the retail investor. So in order to kind of smooth out the weekly readings, I calculated an 8-week moving average of bulls minus bears. So if you have more bears than bulls, it's a negative number. Which is pretty rare. You don't see that all that often. So we've had 29 consecutive weeks of that 8-week moving average, more bears than bulls. So over the history of this indicator, they started doing this in mid '87. So like right near the crash of '87. There's only been 3 other periods, so what's that? In 25, was it 87, 97? In 35 years, there's only been 3 other periods where you've had more consecutive weeks. One was you had 30 weeks in 1990, and that was during the first Iraq War, and we had an 8-month recession. And then the financial crisis of 08-09, there were 45 consecutive weeks where that 8-week moving average showed more bears than bulls. And of course, the financial crisis of 2008, 2009, those are truly scary times. I don't think what we're going through now compares to that in any way. I mean, the economy is actually still quite strong. Obviously, we're dealing with higher interest rates and
Inflation, and there are those recession fears.
Yes, and we likely will have some type of recession. And I think the kind of common wisdom today is that it'll be fairly shallow, but at least the Fed is finally responding, and the market's anticipating kind of what's happening. So I don't think we're in any type of situation as similar to 08-09, which was truly a collapse. And then there are 35 consecutive weeks during COVID. So the way we are positioned now on that survey, with 29 weeks, that moving average is going to take at least 6, 7, 8 weeks in order to turn more positive, assuming sentiment gets better. So we're going to be, I'm almost positive of it, this will be the second longest in history, which is, that's saying something, right? Investors Intelligence Survey, that's a professional newsletter writers, 12 consecutive weeks of more bears than bulls. There's been 6 other periods since 1980 where we've had a longer period than that. So it's not, unheard of, but that's pretty bearish. I mean, usually you don't get that many bears over bulls. The VIX, we had conditions where the VIX was over 30 for a large part of the first half of this year. I know a lot of commentators are saying, we haven't spiked enough. The VIX has to go up to 50 or 60 or more.
Yeah, it's cooled off.
It's cooled off, but anything in the mid to high 30s is pretty extreme readings if you look at the historical chart. So the fact that it persisted for so long, they say you either scare them out or you wear them out. And I think this has been a combination of both. We had a spike in the put to call ratio in mid-June to 1.27, which is quite a high spike over the last several years. And another indicator I use is called the short-term overbought oversold oscillator. Has had about 5 pretty extreme negative readings over the first half of this year. And just to mention how I said, you were getting very oversold conditions even much earlier in the year. On January 27th, it was the most oversold in the history of the NASDAQ. And that even more than the crash of 87. So we've hit a lot of extreme readings on secondary indicators, and Bill O'Neill would say, well, they're secondary, you can't really rely on them. You want to rely on the market itself, which is true. And I think my over-reliance this year is the reason why I was slow to exit and took some pretty heavy losses personally. But I think there's been enough damage personally, and we might go lower, we might retest, but it's been pretty bad. So I think I'm going to be optimistic here and look for the technicals to continue to improve and see if we can get some new leadership.
Yeah, that is definitely important as we start to see this rally unfold, if it's going to have any legs. So Charles, what would you say would be the biggest takeaway then after reviewing all of those secondary indicators? Clearly, you don't want to rely on them too much, but you also need to be aware of them. So it seems like there's a delicate balance there.
Yeah, I think the takeaway is this. I think you can't wait until you feel good before you start to invest. You can't wait until it's obvious that everyone sees, oh, the market's we're in a bull market. I mean, at that point, you will have missed a lot. So again, you want to take a measured approach right now. You don't want to get too fully invested, but you want to take your shots. I mean, as long as the market is, the technicals are saying that things are improving, breadth is improving a little bit, the more growthier sectors are starting to rise. So you want to, take position, take some shots. You don't want to be afraid, because just like, when it comes to cutting losses, a lot of people are like deer in the headlights, and they're afraid to take a loss, or they're afraid to take that first step. It's the same on getting back into a market after a major correction. I mean, it's scary, and it's quite common to begin to add exposure and then get a pullback and actually go lower. Your account will go lower, right? So, you're up off the bottom, you're waiting for a follow through day, you get a follow through day, the market's already up off the lows. It's very common to have a retest where your account is going to go even lower, because you're not going to nail the bottom, right? You're not there on the bottom day. You're waiting for confirmation. So that's why you want to take a measured approach, not get too fully invested yet, and be prepared to maybe cut losses, or to take a little bit more pain. The way I think I would approach this is doing a combination of buying stocks that are moving through pivot points, that are traditional breakouts when they occur, but also not being afraid to buying on a pullback if a stock is already broken out, or in an uptrend, or even if it's maybe in the handle and you see an upside reversal. I wouldn't buy just because the stock is going down, but I would look for stocks that have already formed the right side of a base, or are forming that right side. And if they pull back and then show support, like an upside reversal day, I think that would be an appropriate point to take a chance. I think only buying stocks on strength, particularly in this market, kind of also fraught with difficulty. I think you need to do a combination to put the odds in your favor.
Yeah, because breakouts have been challenging ever since we did see growth top back in February 2021. It just seems like breakouts haven't been working like they were in 2020 and in early 2021. You know, like you said, the commodity stocks really caught fire earlier this year. But if it seems like for a lot of them, if you didn't get those initial breakouts, it was tough to enter, and you really needed those pullbacks or reversals as your areas to get in. And there a lot of breakouts for the few and far between more traditional type growth stocks that we've seen have been very tricky, and a lot of them very short-lived breakouts. So it
So
seems like if we yeah, go ahead.
I was going to say, so buying breakouts in a bear market, it's not going to work.
Exactly. Yeah, you
And
have to have the market with you. So if we start to see this
yeah,
rally pick up, then you would think that breakouts would start working better.
well, in fact, I would say buying anything in a bear market typically isn't going to work well. The odds are not in your favor. So even, people say, oh, Charles buys pullbacks all the time. I do like to buy pullbacks, but buying pullbacks,
In an
um,
uptrend.
you have to be in an uptrend to buy a pullback. If you're in a downtrend, you're in a downtrend, right? So pullback buying is really stocks that are kind of having temporary corrections within a larger uptrend, not just stocks that are going down. That's not a pullback, that's a downtrend. And this has been a particularly tricky year because it's been very rotational. So while we've been in a bear market, we did have those select sectors working, right? We had energy working, we had the fertilizers working for some time. We had some of the commodity steel type stocks that there were sectors that were working during the year, but those aren't those traditional growth sectors that trade like growth stocks. And so I've never made money in an oil stock. I mean, they don't trade like growth stocks, and they're much choppier, they're much more difficult. The shipping stocks, right, were working for a long time. But
Yeah.
you can see, I mean, when they correct hard. So if you look at stocks like Mosaic and Adco and CF and those stocks that were working great this year, they've gotten creamed, right? So they weren't they just didn't have legs, right? So it's been tough. It's been a really, really tough year. It's been a year to be in cash.
Yeah. Well, hopefully, a lot of people are in a good position to focus on what's next. But even though it seems like next week could, if all the stars align and all the news is great and everything's happy, even then, you don't want to get too over ambitious or over aggressive, because as you said, with all of the damage that we've had so far this year, and that we're just now starting to turn, it could take a while for things to really digest and for those proper setups to form. So before we get to a couple of stocks on your watch list right now, because you talked about some new leadership and maybe looking at former leaders that are still looking interesting, hint, hint, maybe Tesla, we'll sneak in a little mention of that. But before we get to that, I do want to take a look at a historical example. We'll go to the S&P 500 in 2009, because Charles, you are so great at analyzing stocks and the market, and I think looking at historical precedents is something that is so fascinating about what you do. So I would love to look at the S&P and its turn in March 2009, and what this is saying to you, and some stocks around this time, like what we can learn from this past market cycle. Even though the current market may not play out exactly like this, I think there's a lot of learning lessons here.
Yeah, I mean, the only reason I'm using this as a precedent is because this was the last really major bear market that we've had, where stocks were where the correction has been that deep amongst growth stocks. I mean, the S&P 500 was down, what, like 50% or something in 08, 09. So we obviously haven't had, we've only fallen about half of that on the S&P 500. So, but the growth stocks, many of the growth stocks have had corrections equal to or greater than during this 08, 09 period. I mean, it's been devastating look at Netflix down 75%, PayPal down 75%, Square down 75%, Nvidia off over 50%, AMD off over 50%, Shopify off like 90%. I mean, it's been pretty crazy what's happened in the market. Tesla down 50%, at its low. So it has been as bad as I've ever seen, to be honest with you, even though the overall indices haven't been quite as bad. And the reason for that is because we did have a rotation into energy and commodities and food stocks. And there were some things that were working. So in a way, like the general indices are kind of masking the damage below that occurred to the technology and speculative areas. So, and I'm not saying we shouldn't have had big corrections, because things got very frothy, and you had the whole, crypto craze, and you've had a meme craze. You've had a lot of froth in the market, but it has been very severe. And I think the selling has been quite relentless over the past year and a half. I mean, the ARK funds topped in, I guess, February of last year. Mm-hmm. So it's been a year and a half. And, the ARK ETFs off, 70, 75%. It's pretty bad. So,
yeah.
So anyway, that's why I'm looking at 08, 09, because that was the last time we've seen this kind of damage that was so widespread. And on the S&P 500, we had a follow-through day on March 12th of 09. Mm-hmm. And in the NASDAQ, the follow-through day actually didn't occur until, I believe it was the 18th. I think, yeah.
You want me to go to it? You want me to go to the NASDAQ?
Yeah, you can pull that up. And that would be March 18th, 09. So those were the follow-through days. Mm-hmm. And the damage was so severe, there was very little to buy at that point. The first stock that broke out, which I think
it's not traded anymore.
Yeah. Green Mountain Coffee, Keurig, was the first stock to break out. It actually broke out the day after the NASDAQ broke out. But if you pull up Amazon, for instance, mm-hmm. It actually broke out the day before on March 11th. And it wasn't maybe the handle was a bit low. It wasn't, it was a little bit of an earlier breakout. And you can see that it still took all the way through July or even longer to get to new highs. But those were some earlier entries that, around the follow-through day that you could have started to take positions.
It was above the 200-day. I think that's another. I mean, not necessarily all stocks are going to be in that kind of position, but I feel like that's an added bonus, right? That it's
for sure. Yeah. I mean, if you're certainly above the 50-day, and if you can get above the 200-day, I think if you studied a model book, you'd see that nearly all of the model book stocks would begin their moves above a 200-day moving average. And you can argue that, maybe the first, this is a little bit of an early time to buy, but you want to try to buy stocks that are showing good relative strength. And you can see the RS line is, in new high ground when it's had that early breakout in March. Apple's another stock that I took a position in early here, and now it was way off its highs when near the near the breakout. But you can see that while the market was hitting new lows from October '08 through March '09, you had that undercut. Apple actually was consolidating sideways. So it was actually, the relative strength was actually improving versus the market during that time period. And in March 18th, which was the follow through day, you had kind of a very early buy off that kind of, I don't know, you guys might call it a bottoming base. I mean, actually, I'm not sure exactly how you define that, but you can see that you had this consolidation area along the lows. And then from that point, you kind of had a clear move up above that level. And I think it's important to kind of orient your eyes toward these types of setups, because the damage has been so severe. You're going to see, stocks that eventually come back, they're going to end up looking like this, where they had a massive correction. They go through a kind of a consolidation retest phase that may last several months or more. And then they'll, the ones that are going to work will begin to move up above those sideways areas. And eventually, some may never get to their highs, stocks that fell 90%. But if you fell 50 or 60%, that's a pretty deep base. But given conditions, I mean, that's what's going to happen.
Just really quick, I feel like this is a great reminder, because a lot of the really beaten down stocks, some of them have started to consolidate and make some higher lows. But, like for the chips, for example, we're just now starting to see them getting above their 50-day lines. And so what you're saying, it's a good reminder that it could take a couple of weeks or a couple of months for some sort of trading range and therefore buying opportunity to form.
Yeah,
a lot of this.
That's what I'm expecting to happen. Wolf, WOLF, which formerly was Cree Semiconductor Company. This was one of the early kind of big winners during this period, and it broke out on also on the follow through day, March 18th, offered a kind of an early entry. But you can see it took another few months before it actually got to new highs. If you go forward a few months to August and October, so maybe go out to November or December, you can see it turned out to be a big winner, but it gave you many opportunities to kind of get in. It would move up and consolidate and retest. But you can see that it pretty much held, once it got above the 50-day moving average, that line served as an area of support on the way up. So, when I talk about buying on pullbacks, this is a kind of a perfect example of a stock that's in an uptrend. And if all you did was buy it on strength, many times you're going to get shaken out, or you're going to have a quick retest back to the 50-day. Not every time. I mean, there were some legit times where if you bought strength, it continued to move up. But that's why I mentioned do a combination of both. And that's how I normally trade is I'll buy every opportunity. If I like a stock, I'm going to take every opportunity to add to my position, either, moving above resistance to new highs and at a support level like the 50-day moving average, or an upside reversal at a support area. So I think it's important to kind of orient your eyes toward these kinds of stocks and how they played out following the 08-09 timeframe. Again, because we haven't had this kind of damage in quite a while.
There's two more just quick ones that we could take a look at before we look at some current stocks, and that would be Netflix here. I think that was one that you were mentioning. It took this one a little bit longer, and it formed a bit of a bigger base before it really started moving. Or maybe this was a different time period example. I'm not sure, but I had this written down from our discussion.
Yeah, this one was early to get to new highs, but then I went through a long basing period. Like if you bought it near the follow through day, it didn't last long, and then it went through another consolidation period. So that maybe wasn't my favorite example. Chipotle, CMG, maybe throw that up. That in the March time frame kind of gave you some early buy points, and then it went through a longer consolidation period. So I think given that the many stocks are way off their highs, it's going to take them a long time to really come back toward new highs. And so you can expect, to make a good amount of progress, and then back test and retest areas of support, go sideways. And so that's why I say if the rally is for real, there's really no need to get too crazy about getting in right away. Take your time, let things play out, take advantage of those retests in stocks that are showing good relative strength and support. And don't feel you need to get fully invested too quickly.
Mm-hmm. Such a great reminder, especially because, as you mentioned towards the beginning, Tesla had a really nice positive reaction to its earnings report. So I'm sure a lot of investors out there were buying, maybe nibbling, or at least experiencing that sort of jealousy factor with the strong move that it made.
Yeah, Tesla, I mean, honestly, I've been shocked at how it's traded this year. I mean, I did lose quite a bit of money, or I should say, lost quite a bit of my profits.
Yeah.
In fact, at one point I'd given back basically everything I made last year, which was a lot. So,
Yeah.
But I did mention on IBD Live, I actually got a margin call, and I did have to cover, and it's been pretty ugly. But I still have about half my position that I had in the stock, and I would, Tesla was one of those stocks that did not undercut and hit a new low when the market hit a new low. So similar to that Apple chart that we showed back in 2009, where the relative strength was improving. I think Tesla is acting better, and as bad as it's been, I look at these past several months as kind of that consolidation period along the low. And when we kind of judge bases or analyze bases, we look for elements of support and elements of strength within the base. And this week is going to be an element of strength, right? If you pull out that daily again, you can see that great reaction to earnings, heavy volume gap up, closing at the top of the range. Assuming this continues to move up from this point, that, in hindsight, you're going to look at that and say, oh, well, look, it had this element of strength. So, you don't have to always wait for the big. I mean, I'm not saying go rush in and buy the stock. I mean, I've had a position. I've been waiting for some good news. So finally, it was a very good report given what they were up against with the Chinese government basically shutting down their operations for an entire month. The fact that they were still very profitable and still had pretty good margins, and they, they're very, financially sound. They've got $20 billion in the bank, and they have a huge leadership. I mean, I can talk about Tesla for days, right? So, I mean, I don't know if I want to waste our time on that at this point, because I've talked about it so much in all my previous appearances, but nothing has changed except, if anything, things have just keep improving, in my opinion. And now we have 2 new factories that are ramping up. There may be some difficulties and snags during the ramp ups, but I'm not looking at this for the next month or two. I'm looking at this for the next decade. And I can pretty much tell you that a year from now, those new factories are probably going to be humming. It might take a quarter or two for them to kind of get the snags out, but they will. And why wouldn't they, right? They have every other time with their other factories. So Um, so,
Yeah,
and
we'll have to see. But
yeah,
it's
and the fact that,
step in the right direction this week.
yeah, and this is, one of those speculative growth stocks can be that can lead a market. Um, if you compare it to like a Netflix that fell 75 or 80%, this fell 50%, which is a lot. But I mean,
Mhm.
all in all, given what a lot of other stocks did, it's, given the run, it's look, when you go up tenfold, you're probably going to get something back in a bear market. And it did. It's been really rough. But I think this can offer new leadership. But, there's no need to rush into it. If it works, it will form a proper base and give you a proper entry.
Well said. We just have a couple minutes left, so the rest of this is going to have to be kind of rapid fire.
Okay.
So speaking of kind of former leaders or older leaders or established growth companies starting to turn, Tesla being one of them you have your eye on, also Nvidia and AMD. Any quick comments here on these two chip stocks?
So these aren't really in position to buy yet, but you can see that they've come up against resistance at their 50-day moving average, and this is a normal area where they should probably pull back a bit, but these are stocks that have sound fundamentals and leadership positions that I would expect to come back. Okay, so you like in those examples we showed from 2008, 2009, wait for those types of setups, to maybe get some earlier entries. Assuming that this goes sideways for a few weeks and then offers what looks like maybe a kind of a buy over a move over resistance, so you can begin to take positions there. One that's further along is on semiconductor. This one is on relative basis. You can see the RS line is near new highs. It corrected down to kind of the top of the previous base. Didn't fall nearly as much as many other stocks. So I think this is something that can be one of the earlier ones to form a proper base and offer kind of a normal type of entry. Palo Alto Networks, PANW, I think, is another one that didn't correct so much and is, now show. It's coming up against the 200-day and the 50. So I think if it can break out of this range, that can offer kind of an earlier kind of buy. And there's some newer stocks too. Like there's Funko is a stock that you guys feature quite a bit on IBD Live, and that's like a really nice saucer pattern. I don't really know the story, but you know what? I know it's like a toy company, right? And they have like little like figures.
They do. They also have board games. I didn't really know this, but I saw another Amazon treasure truck alert for a Disney board game.
Oh.
And they're doing exclusive Marvel releases partnering with Amazon. So that's
sometimes, when I think I kind of just quickly looked at their website and I saw these like NFL figures, and I know that a lot of people collect those types of items, and in a way, it feels a little bit faddish, and faddish stocks can be huge. And they usually don't last, but they can be big. And you know what it kind of reminds me of is back in '99, a stock I was trading was 4Kids, which was the Pokemon stock.
Pokemon. Okay, I was gonna say, is that Beanie Babies or something? But okay, Pokemon, that makes sense.
And that stock went up like tenfold in a short period of time. Of course, we were in a super speculative time frame too in the late '90s, but yeah, these types of stocks can sometimes make big moves, and I really think this is a very constructive looking base. So I think there's an opportunity in something like that. Ulta and ELF in the cosmetic areas. are both holding up really well. Shockwave, SWAB, is one of your maybe early new leaders, which is also pretty much at a buy point. So, I mean, their pickings are still slim, but you're starting to see companies in the sectors that we want to see, you know, in the growthier sectors, start to come up and bubble up. So these, you know, are some of the stocks you can maybe start to take a look at.
Awesome. Yeah. I was just going to say in closing, because I know you got places to be. Just so to wrap things up, in summary, we looked at a lot, so much great education, and so much that we can always learn from the past and even the current to help us become better investors. So, final takeaways, Charles.
I guess my final takeaway would be it's been a very difficult year, but these types of markets in the end are kind of what you need to kind of sow the seeds for a new bull. And there's going to be tremendous opportunities coming up. I feel later this year and just going into the future. And so as painful as these periods are, if you can avoid getting too hurt, you know, this is in the end going to be a gigantic opportunity. So, you know, don't give up. Keep your watch list ready. Don't be afraid to take on some risk, but do it in a measured way. And you'll be surprised that once, you know, things start to work and you have a few wins under your belt, you know, confidence comes very quickly when you start to make money, and you can kind of loosen up a bit. And hopefully, you know, once we get a reliable uptrend where you can kind of trust the pullbacks, you'll know that you're in a better environment where you can push it a bit.
Excited for when that might come. So we'll have to see, but we got to stay optimistic in the meantime. So thanks for that little pep talk there at the end, Charles. And thanks everyone in our audience for watching and for all the love for Charles. We appreciate you tuning in. And Charles, always great to talk to you. Thank you so much for spending the afternoon with me. And we'll have to have you back on.
Yeah, Allie, I'm looking forward to that. Thank you.
All right. Thanks so much. Thanks again, everyone, for tuning in. See you back here next week.
All right.